Well, good Monday morning and welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director at the California MBA, and we're finishing up our focus here in June on the capital and secondary markets. We've got a great guest, and we'll jump into the conversation with him here in just a moment. But first, let's thank our sponsors over at Accelerate. So Accelerate helps lenders close more loans through better borrower engagement. The mortgage industry's most innovative customer experience platform delivers lead management, sales enablement, engagement, a robust mortgage-specific content library, and data intelligence, all in one comprehensive and highly scalable platform. Accelerate delivers dynamic technology, strategy, and content for every channel of your business to ensure engagement throughout the customer journey, whether it be with your borrowers, referral partners, or any other party to the loan transaction. The dynamic enterprise solution seamlessly fits into your tech stack, whether that's your phone integration, your POS, your LOS, servicing system, or data enrichment, due to their advanced API connectivity, modern design, and open architecture. Gone are the days of managing multiple and separate systems like your CRM, your marketing automation system, lead management, and having your data trapped in silos. The innovative platform allows you to provide your internal and external customers timely, relevant information based on data intelligence to build repeatable outcomes at each stage of the borrower's journey. Bottom line, you close more loans, improve borrower conversations, enhance customer retention, transform your customer acquisition lifestyle, and create customers for life. So for more information, visit accelerate.com, or you can dial the number listed in the description below. So before we jump into the conversation, I want to toss it over to Susan Milazzo, our CEO, for this week's weekly update. Susan?
Thanks, Dustin. Hi, this is Susan with the California MBA. And this week I'd like to talk with you about our Western Secondary Market Conference happening in person at the beautiful Waldorf Astoria Monarch Beach Resort Hotel in Dana Point. We have some great speakers and sessions lined up for our agenda, of course, including today's podcast guest, Phil Rasori, who will be speaking on our capital markets panel. We also are going to be talking about mergers and acquisitions, servicing, technology in the mortgage space, then what's happening in the non-QM market, as well as our CEO panel and the Empower Leadership panel that'll be led by Marcia Davies from the National MBA. We're really looking forward to being back together again this year at this beautiful resort, and I hope that you can join us. Registration is open, so visit our website and get registered, and I look forward to seeing you in August at Dana Point. Back to you, Dustin.
All right, thanks, Susan. Now let's jump into the conversation. I'm excited to welcome in an old friend of the association. He's spoken at many of our conferences and been a big supporter of the association for a long time. Phil Rasori, COO at MCT. Welcome, Phil.
Thank you, Dustin. Great to be here.
Yeah, it's great to see you again. Phil has always been one of our speakers. If you've seen him before at our conferences, you've most likely been at the Western Secondary, where he's spoken on our capital markets panels over the years. So Phil, for those though that maybe don't know you, tell us a bit about your background, what got you into the industry, and what led you to where you're at there at MCT.
Yeah. So really, I'm MCT really through and through. Out of college. For those of you that have seen me and don't know, I look a lot older than I am. So graduated college in '01 and. Had some computer science background and math background, and actually did some mortgage brokering early on. But then by beginning of '03, I came on with MCT and have really been here ever since, and really been blessed with a good team and great business partner in Curtis Richens, and so it's been a great ride, and really excited about the future here at MCT.
Yeah. Well, I'm curious. I mean, you said you kind of went to MCT right out of college. Were you always interested in real estate markets or capital markets, or that's? I mean, it's not necessarily one of those things where you can you major in. Not too many people these days are majoring in real estate. So was this always something that was a passion of yours?
It's a great question, because I think that's one thing. Whenever we hire, I went to University of California, San Diego, and over the years, because we're based in San Diego, I've hired about 30 30 students or so from directly out of San Diego, UC San Diego, and they all kind of say exactly what I said. They really didn't understand that this sliver of the mortgage industry, really even existed. No, for me, I'm definitely looking for something in the fixed income trading space. And this was just perfect because I already had some knowledge on the origination side, and I do think that experience early on in small experience in on the broker origination side definitely helped me through the years in secondary to kind of understand the mindset of the originator, which is always good. Although the world's changed a lot in the last 20 years, and continues to change. Obviously, it's good for those of us in secondary to continue, especially in secondary vendors like an MCT, to continue to understand what the ownership at a lender has to deal with, on the origination side, because sometimes, or a lot of times, those interests can be perpendicular to the interest of secondary and the profitability of the lender.
Yeah. Well, and you kind of mentioned that your the sort of the breadth of your knowledge and experience in the industry going back to, you said in the early 2000s. What was it like? I mean, we didn't really talk about this prior, but I'm curious, what was it like, getting into sort of the secondary and capital markets that early on, right as the boom of the early 2000s started, and then obviously things, crashed the way they did. How did that shape that early part of your career?
Yeah, it's a great question when you think about 2003. For those of us that were in the industry in 2003, it's a little bit similar to kind of what we saw at the beginning of 2021. There was this rally in bonds basically ever since 9/11, through 2002, early 2003. Rates just continued to drop. And what would be considered, of course, high rates now, but they continued to fall and fall. And then in late June, the market basically turned around, and rates just shot up, and there was some big like Capital Commerce, some big name groups that went out of business because they weren't hedging properly, and that definitely helped the hedge advisor world, show the value of in the absolute need to properly hedge your pipeline, even in a market where the world thinks rates are going to continue to drop, which is really, if you take yourself back to that time in early 03, a lot of people were just thinking that it's going to continue this way, and of course it turned around in a hurry.
Yeah, when you had a lot of people coming into the industry at that time that didn't have a long experience in the industry, and I came in 2004, and it seemed more like one of those things. I mean, I had no background in the industry, and it was like, oh well, I mean, this industry is fantastic. Things are always on the upswing, right? There's no downside apparently to this industry. Obviously there is. For those that have been in the industry long enough, they would always say, it's feast or famine. It's feast or famine. There's going to be there will be another side to this boom here, that for those that aren't prepared for it, they'll pay a price.
Absolutely.
So, looking back here in just this past year, obviously it's been another year that's been a challenging year, to say the least, for folks in the industry. So for you, just what was maybe the biggest lesson that you learned over the past year, whether that's professional or personal?
Well, look, I think professionally, we were definitely proud at how we communicated early to our clients at some of these critical times, as there was a lot of uncertainty out there. I think the lesson learned is just the value of that communication is huge in times where you really don't know what's going to happen. I think that it's if we just take ourselves back to that month of March, that was an incredible period. If you think of kind of everything that happened in the first couple weeks of March, where rates just precipitously dropped, the concern was just normal pull through. Then as the stock market fell out, the MBS market fell apart. So that was a concern that just MBS was going to trade as a risk asset and rates were going to go through the roof. Then the Fed came in a big way and turned things around the other direction, and everybody thought they were going to go out of business from a margin call perspective. That all happened in a period of less than 3 weeks. So it's just incredible how many worlds we were in a period of 3 weeks. So I think, just the continued communication with our client base, I think, specific, just getting into the weeds of the specifics, I think it's, MCT as a organization working with small lenders will kind of redouble our efforts to get our lenders agency approved. I think that's that was definitely shown that, in times of crisis, you need to be able to at least control your own future with the agencies. Now, as we're seeing now with shifting pricing at the agencies, that's not necessarily, a cure-all, but it definitely takes one layer of risk out, having that option to execute at the agencies.
Yeah. So, I mean, things are obviously changing right now. We're in a sort of a shifting market here. So what's the latest at MCT? What do you guys see going on right now as far as, the company itself and what you're talking about with clients and prospective clients about what to keep an eye on right now?
Well, look, I think the biggest thing is, it's apropos timing, right? Our podcast here after, I guess about a little over 24 hours after that Supreme Court decision, allowing for the current administration to remove the current, FHFA director. Look, we all have our opinions. I do think that regardless of, if it was the director or just FHFA in general, the current regime was creating a lot of market disruption. That's the bottom line. You cannot continue to give these directives that are substantial, big changes with no lead time. And that's been a problem if you think of basically ever since April of 2020, as we started some of those forbearance communications on, what would be purchased, then the orphaning of the cash outs, to the refi, the 50 basis point refi hit last fall, to, of course, all of this non-owner occupied and second home and the PSPA stuff in January. There really just has been a complete lack of lead time. So we're definitely hoping that, that we're going to see some changes there, because I think that if you subscribe to the theory that, FHFA is truly trying to just capitalize the agencies, the problem with creating uncertainty of that lack of lead time is you create friction. And any economist will tell you that when you create that friction, you raise more. Basically, you raise more in fee to the borrower than you get to the agency, because that uncertainty and that friction has to materialize in larger margins at the front end from the lender to the borrower. That's the bottom line. And so, I think the biggest thing right now to watch in the next, however many days it takes the administration to find a permanent director and get that director confirmed. I think the biggest thing to watch is kind of the motions out of FHFA. I don't think we're going to see a lot of positive changes to second home and non-owners. If you think of just, the kind of where the Democratic Party sits, right, landlords probably aren't their first, aren't top of mind to protect, right? And wealthier people with second homes probably aren't top of mind. But if you look at some of the other risk layers of PSPA, I don't see the Democrats killing, hurting people with high LTVs and lower FICOs and higher DTIs. So I think and maybe some of the cash window stuff. I know that you guys at CMBA have done a lot of work at that, and also the MBA, and I think we're all hopeful that we can get some of those cash window caps relieved. But that's where, as far as what's going on, kind of specific to our industry, I think that's what happened yesterday is the potential for a big change, for a positive change, because frankly, some of the moves over the last 16 months have been, almost, it could almost be classified as hostile, to the mortgage industry. So hoping for some changes there.
Yeah, absolutely, absolutely. So, looking maybe specifically at hedging strategies, what should lenders keep in mind? I mean, based on everything you just said there and everything that industry is going through right now, what should we keep in mind when it comes to working through our hedging strategies?
Yeah, it's a great question. I think that if we just kind of tail off of what I just said on second homes and non-owners, I think you have to be you have to be very careful of bringing that production in. I mean, most everyone who's listening to this podcast knows or maybe has already been affected. But some of those ratios, when Fannie Mae pulls you down from what was thought to be a 7% limit down to 3%, and then pull some lenders down to 0%. That's highly problematic, because what happens is on the aggregator side, so let's say you're a lender that's selling to the agencies. Now you have to turn around and direct that fire hose to the aggregators. Well, the aggregators are seeing that they're seeing that across the board. And they obviously have their own ratios to worry about. So controlling that production at the front end, you're going to continue to see best effort pricing worsen on the non-owners and second homes. There's no question about that. Look, there's a market. There's a market for it. There's a private money market for it. There's been some recent success stories with some large aggregators. The question remains as can the PLS space handle the sheer volume of let's say 12% of the industry that's coming down the pike, and that remains to be seen. I mean, obviously there's a yield level where non-owners and second homes make sense, but I think it's probably at the scale that we're looking for here, it's probably a little bit higher than it is now. So that's a long way of saying in the hedge, for a small to mid-sized lender, I think you have to be very careful of, especially if you only have aggregator executions, you have to be very careful of monitoring how much production's coming in of that second home and non-owner production right now, because we just don't see. And again, going back to just the political landscape, I don't see a huge political will. Dustin, you and your group probably at CMBA know far more about this than we do, but we don't see a huge political will on the Democratic side, to fight for the guys who own a lot of rentals.
Right. No, I think you're right. You're spot on there. So and maybe you answered this or hinted at least talking about private lending space. What do you think is going to be maybe the hottest market or product? Let's just look forward 12 months from now.
Yeah, well, I think we'll just stick to the laser focus that we're in pure secondary. I think that obviously, like you said, I hinted at the non-owner, the second home space. that's a that's a valuable market. It's not just, as you well know, it's not just from the origination perspective, it's the originator retention perspective. Obviously, originators that of all of our lenders that have a lot of second home buyers and non-owner buyers, those are generally the higher value, high value originators that you want to keep. So you have to have that ability to originate that product. So I think that's definitely going to be a hot market. And then we also have to, of course, watch what happens to real estate, values. The HPI that FHFA follows to increase those loan limits. They've done a good job of following. Given how crazy real estate values are, it'll be interesting. If we do see these real estate value increases continue, and the hopefully the HPI index will just materialize correctly given your MSA that you're in. You're going to see substantially higher conforming loan limits next year. Again, if values continue. But with that said, you're still going to see a need for just how crazy real estate values have gotten. You're going to still see this increased need for jumbo lending, and so I think that that'll continue to be a hot market, especially with where real estate values are going.
So, and just to maybe put you on the spot on this, where do you see real estate values going over the next year? Obviously, it's the nature of real estate values. I always, it drives me nuts when you see, national median home price, which it has its place, but it's certainly from just an individual originator's perspective, it's sort of pointless to know if you're originating in Orange County, California, then who cares what the prices are in, Charleston. So,
yeah.
Just from your perspective, what do you see values doing over the next year? Maybe just specific to California.
Well, I think you guys at CMBA and a lot of our lenders, our mutual lenders, clients probably have better ideas on this than we do, since we're focused on secondary. But look, I think that just the basic economics of the fact that materials have not, lumber prices have come down, but materials have gone up. There's obviously the labor issues. It doesn't seem, and then let alone some of the other issues that are hitting us in California of restrictions on building for drought situations. Of course, you've got fire issues. So specific to California, it's hard to see prices go down just from a supply and demand situation, but it is incredible to see those statistics of housing, median house, prices in north of 750,000 in a state with almost 40 million people is just incredible. So it does seem like the economics, maybe not the incomes, but the economics of just building, and just some of the restrictions that we're all facing here in the West, especially in California, support some pretty high cost housing. That's for sure. So I don't see it going down anytime soon, unfortunately, because I do think eventually, you watch the DTIs in our pipeline, eventually you do hit an affordability issue.
Yeah, absolutely. I think you're right on there. So we're getting a little short on time here, so I've got time for maybe two more questions. So next one here, just this is sort of a open-ended here, but what's maybe one thing that if I'm a lender, if I'm a mortgage banker watching this, and I want one thing to take away from this, what's one thing that lenders don't know that they should know?
I think that just going back to, well, a lot of lenders know this, but it's hard to remember. in the heat of the moment of dealing with your business, dealing with your originators. That look, there's going to continue to be changes. We know that. I think with the removal of the director of FHFA yesterday, hopefully some of those changes will be a little bit less abrupt and kind of cause less disruption. But there's going to continue to be changes. And again, non-owners and second homes are such a quintessential example because of those originator retention issues that they cause. But it's hard to remember in the heat of the moment, but you have to look at the overall business, realize that, do you want to risk the profitability of the entire business for 11% of your pipeline? And that's and again, totally understand the originator perspective, but you got to take a step back and understand that at some point, some of these changes require you to control volume through margin at the front end, and that's not fun to do. But we were a broken record about this throughout the pandemic and throughout those changes in the pandemic. Some of our clients that listened to us early on in the pandemic, they lost originators. But it was worth it, right? Because some of the changes that occurred, you had to make it through that tough period of March and April to achieve the best year ever. You had to stay in business. So I think just being able to take those hits at the origination level. I know it's easy for me to say at the secondary side. It's worth it, and always putting it in perspective, because again, when we talk to clients, and again, second homes, non-owners, perfect example, but we could definitely see other issues happen. You're definitely going to see some pricing changes, continued pricing changes from the agencies. We just saw one from at the MBS level that probably that had downstream effects. It's already taken place, so it's not like pricing will worsen from here because of the change. But those are those are changes that do affect your they average out over time, but you're going to see swings in profitability of your pipeline, because of some of these changes. I think, again, going back to I don't want to pin too much hope on this, sell too much hope on the change of directorship, but hopefully some of the pricing changes that we've seen at the agency levels will adjust a little bit, as we see some changes at FHFA.
I think that's true. So closing out here, we've got one more question, and I mentioned at the outset that MCT and you, Phil, have been good supporters of the MBA and the California MBA for a number of years. So from your perspective, maybe talking to a company that's not a supporter yet of either of the organizations and maybe doesn't see the value in that, what, from your perspective, why do you guys support industry groups like the California MBA and the MBA? What do you see as the crucial reason for that?
Well, look, I mean, I think the biggest example is March 23rd through March 30th of 2020. So during that period, starting Monday, March 23rd, we had obviously this just unprecedented, everything was unprecedented, obviously, but the rally that occurred because of basically what the Fed did was just launch this cannon that basically said, we're going to buy whatever it takes. Bottom line, there wasn't a number associated with it. And so you just saw that, definitely shored up the MBS market, which had issues, but then it darn near put everybody out of business because the margin calls kept coming in. MBA, and I know Dustin, CMBA was big in this as well, but MBA, and I've credited Mike Fratantonio on a lot of webinars that we've done. He had contacts over the Fed. I talked with him that Saturday, I believe it was the 28th, at like 6 a.m. He was frantically going back and forth. Look, I don't know that the Fed would have understood what they were doing had MBA not had, and again in CMBA as well, had you guys not had those contacts over there, right? The large lenders, especially some of the depositories, the household name depositories, don't have that same problem, right? So for us to think that the household names will, who do have contacts at the Fed, there's no question about that, and they have contacts at Treasury, but to think that their interests will be aligned with a independent mortgage lender is probably a little bit naive. And so it's absolutely essential to have that support. And you guys, I think, look, again, the mortgage banking associations showed their value during the pandemic, and it's the same thing now. Like I said, I think it's a little bit more of an uphill battle with the second home and non-owners. But there's the cash window caps are huge. That needs to be communicated at the political level, that on January 14th, when Treasury issued that press release, and they said they announced the caps under the title of protections for small lenders, that's just completely false. Because we can show just from a competitive standpoint that you're going to have a concentration of power at the at the tier one aggregator level, which does the opposite. It hurts the smaller lender. So the only groups that are going to be able to have those political contacts and be able to articulate that to these to the the powers that be is really you guys. So it's essential, and that's not because I'm on your podcast. That's the truth.
Well, you've shown that over the years by being a great member. So absolutely. Hey, Phil, great conversation. Great to see you. And for those that want to check out what you guys are up to there, what's the best way to find out?
I think going to our website, or I think we've got a pretty good sales group and marketing group, and you guys can always definitely and we'll be at CMBA, so Western Secondary. So I'm looking forward to that. That'll actually be our first conference back, where we're going to be in full force there. So we're excited for that.
Yeah, absolutely. And if you're interested in more information about the Western Secondary, you can go to westernsecondary.com, and registration's open now. So if you want to see Phil and the team at MCT in person, you can do that at the Western Secondary coming up here in August. And again, if you enjoyed the conversation here, make sure and subscribe to us on our YouTube channel here. You can also find us on SoundCloud, Spotify, and Apple Podcasts. We'll be back again next week for another episode of Connect. We'll see you then.